Live from New York City this morning. Good morning, good morning. Three-day winning streak on the S&P 500. Are we about to snap that? We're negative now by 1/3%. The countdown to the Open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg The Open with Jonathan Ferro.
Live from New York, coming up, the outlook for revenue at Netflix underwhelms. Tesla committed to chasing volume over profit as these cyclicals begin to justify a better tone. We begin with the big issue. Can big winners validate big gains?
Here we are in the midst of the earnings season.
Tech earnings.
We surely do hope that earnings will go up.
We've had this huge boom.
That surging 7 accounting for the majority of that outperformance.
It's very expected that we should have a consolidation.
We'd all like to see better balance, certainly in the U.S. market between tech and the rest of the market.
A little bit of broadening in that market leadership.
We are currently tactically underweight tech.
Stick with tech.
Take some profit. Keep that neutral rating.
I still like my tech stocks, but I think this market is telling me in terms of the performance recently that it is ready to rotate.
Would not be a bad thing at all to move away a little bit from the NASDAQ.
Tech, of course, is where the growth is and is going to continue to be.
Can this AI and really Uber top-led rally continue? I think that's what's really weighing on people's minds.
To discuss, joining us now, Clear Harbour's Aaron Cannon, alongside Emily Rowland of John Hancock Investments. Emily, first to you. Is it time to rotate?
Yeah, it's really healthy to see this broadening of market breadth that we've seen as of late. Obviously, some better than expected results out of the financials, signs that there may be a more durable bottom being put in as far as the regional banks go. So we have been warning a potential valuation risk on the mega cap tech side. You know, we like those names, but we've talked a while about diversifying into areas that are actually trading at a discount. Those are harder to find. We're starting to see participation there in the mid cap space and the cyclical part of the market. So I think it makes sense here to see a broader participation.
Aaron, we're seeing it. The rally has broadened. Is it broader for good reason?
I think so. I think that, you know, the prospect of a recession has trended lower over the last several weeks. You look at the surprise index, you look at the general trend of economic data, you look at CPI trending lower from 9% to 3%. You look over, month over month CPI trends at below 2%. I mean, that's the Fed's target. A lot of the heavy lifting the Fed was worried that they may have to do in the back half of the year with significantly more rate hikes just a couple of months ago. Looks like it may be off the table, that we could be one and done here, and that with employment remaining strong, the consumer remaining relatively robust, there is an argument to be made that this broadening we've really seen since May 31st, which has been quite remarkable, could in fact signal, more longer-term strength in the market.
Emily, one and done or more to come?
Yeah, I think one and done sounds about right. And there's been some really welcome news for the Fed as of late. Disinflation is everywhere you look. You see it from, Aaron mentioned CPI, it's in PPI, it's in used car prices, it's in money supply, it's commodities coming down. The prices paid component in the Philly Fed index this morning provided more evidence that disinflation's in the pipeline. And there are some signs that there's cracks in the labor market. Of course, this morning's initial claims kind of providing evidence on the other side. And pretty interesting, though, to see that the 2-year Treasury yield is up about 10 basis points this morning. That was happening actually before that initial claim print came through. Not exactly sure why. Maybe just a bit of a reversal in some of the weakness that we've seen as of late. But markets are telling you that the Fed might need to get a little bit more aggressive here. I think July is baked in the cake. We'll have to see what happens from there.
Claims look good, 228. The estimate was 240, the right kind of downside surprise. You mentioned the bond market. Yields up 8 basis points at the front end, 485 on a 10-year at the moment, up 7 to about 381. If you take a 3-month time horizon right now, you'll find consensus. Most people believe we're in that sweet spot. You go beyond 3 months, that's when you get some division. Let me give you 2 quotes. Max Kettner, HSBC. We extend our constructive stance on risk assets as fundamentals are still supportive. Here's the but. This support is likely to be sustained until late summer, when inflation begins to rise again. Andrew Hohenhorst of Citi saying something similar, acknowledging the next few months are likely to look like a soft landing, then saying this: we see upside risk to inflation and downside risk to growth re-emerging in late 23. Emily, that division, After August, into September and beyond, what are you saying to clients about it?
Yeah, so John, it is the summertime, and what's happening right now is the bears are like melting in the hot summer sun right now. They're vanishing like every single minute, and we're seeing it based on this. Again, it's a really a celebration of disinflation that's happening. It has caused the dollar to weaken over the last couple of days, which has really helped spur this risk-on rally. And I think it's right to think about sort of what comes next, because in every cycle, this once we see these trends of disinflation, it's actually not great, because it means growth is slowing. And remember how powerful inflation has been for corporate revenues, for pricing power. We just saw the best top line growth that we've seen in a very long time from corporations, especially ones that were able to pass those higher prices along. So as disinflation turns into slower growth, it's going to cause company margins to get compressed. We all know the cost of capital is extremely elevated. As companies defend those margins, the employment rate's going to go up and earnings are going to slow.
Oh, and let's build on that. As Emily pointed out, they told us inflation was good for earnings. Is disinflation bad for earnings?
Well, not necessarily, but I think that there's the other sort of powerful force of just the flow of liquidity. You know, when you look at the COVID period, you had QE, you had fiscal stimulus like we had never seen in our lifetime, and that sort of tide is going out. And I think, you know, to the extent that employment can remain reasonably strong, inflation or disinflationary trends continue. Maybe they become a little more bumpy as we approach the sort of 3% and 2% level on headline. You know, that could augur poorly for equity markets. But, you know, we have to think about price too. You look at what the market is anticipating already for 2024 earnings. It's like $246 a share for the S&P 500. That's an 11% growth rate from an already seemingly optimistic 224 full year 2023 estimate number that's right now on Bloomberg consensus. And so that's at over 20 times estimates. That's not cheap. And so I think caution is warranted, even though in the long term, we're big believers that equities outperform most major asset classes.
And just to build on that, when do you expect rate hikes to start to bite? When do we start to see that pain come through a little bit more clearly?
Yeah, that's a great question, Jonathan. I think if you look at the last 16 months ago, we were at 0. As of next week, we'll be up 550 basis points. And the vast majority of that has occurred over the last 11 months. And so I think that's really an important point there, which is, you know, a lot of this tightening, and we know that it occurs and it impacts the economy with a lag, has just occurred over the last 6 to 11 months. And, you know, certainly the Fed's aware of that. I believe the market may be aware of that as well, which is why even though we're not back to the 2% level on year-over-year CPI, the Fed may start to signal more of a neutral posture going forward.
Well, I can tell you, discretionary spending is still holding up in a big way. Check out the airlines, pre-market. Let's get that on the screen. American Airlines at the moment, just a bit softer. We're down 2%. United up 2%. But do year to date. Year to date, United up 45, American up 46, Delta at 48. We had some earnings from them a little bit earlier this morning. Bloomberg's George Ferguson joins us now for a quick look at them. George, Delta was decent. Has United followed suit? American too?
We just saw American earnings pass this morning, and so it confirmed what we saw from United and Delta, and that was fare environment is very strong. Though American, you noted, is down a bit, and I think that's because their guidance for the third quarter was lighter than both United and Delta, and was sub mid-single digit sort of operating margins, which is a bit surprising. I think we're trying to figure out whether or not they're sandbagging a little bit, or there's going to be more of an effect from the JetBlue NEA unwind, where American and JetBlue were working together in the Northeast.
George, we're having the conversation this morning as to whether discretionary spending can hold up beyond this quarter into the end of the year and beyond. What kind of guidance are they offering on that?
Well, yeah, so I mean, what we've seen is domestic yields both for all three airlines flat to last year, so it's a bit surprising. International a lot better. So it seems like there might be some, exhaustion on their biggest market, which is domestic. Could mean the consumer's slowing a bit. I mean, we think that generally, 3Q is probably largely baked already because they've probably sold a lot of those tickets. Again, it'll be largely leisure-led. And I think then what we do is we get into 4Q and 1Q. We see if business feathers in, and then next year in spring, we'll start to figure out if the if the consumer is exhausted, if they're going to come back like they did this summer and just fly no matter what the cost.
Or if corporate spending can do some heavy lifting too. George Ferguson, George, thank you. On the latest from the airlines, Delta, United, American, those names performing so well year to date. The question we keep returning to, can discretionary spending hold up? This from Sarah Wolf of Morgan Stanley. Discretionary spending is likely to go down. Delinquency is likely to rise as consumers face the end of a 3-year reprieve. We're talking about student loan repayments. Capital Economics on the same thing. Gone back to this quote a few times from Capital Economics this week. There's always something to worry about. This is what they're worrying about. Excess savings all but eliminated. The impact of higher interest rates and tighter credit conditions gradually starting to feed through. Student loan repayments scheduled to resume. Aaron, how worried should I be about all those things in a second half?
Well, if we're entering even a light recession, employment tends to be the last leg of the stool to drop. And so it's not a leading indicator. And I think that the consumer is obviously critically correlated to that figure. And we'll keep our eyes very keenly focused on employment. But you look at credit card revolving lines, and they've really extended. And where have rates gone on credit cards? Over 20%, right? So that's a challenge right there. If you look at the savings rate, it's dropped to historically very low levels. You look at auto loan delinquencies, they've trended up even though employment's remained strong. And then, of course, as you just suggested, student loan repayments are going to kick back in again. And that's another weight on the consumer, particularly the younger cohort consumer in the U.S. So we haven't seen retail earnings to any great extent. We're going to start to see that next week. But that may shed some light on some of those trends, too.
The futures this morning down about 1/3 on the S&P. On the Nasdaq, we're down by 0.9%. Ton of earnings out there. Emily, I just wanted to finish on D.R. Horton with you quickly, home builder here in the United States. It's amazing to me, 12 months ago, 12 months looking out, if you'd said to someone that 5% interest rates of the Fed weren't going to be a problem for the home builders, they'd be part of the success for the home builders, I think we would have been like, what, really? But what it's done, as you know, is suffocated supply in the housing market because no one wants to sell their home. How do you get a read on this economy when you have economists talking up the prospect of recession and we have home builders up 40% year to date?
I know, it's like the recession that's just never going to come. And we just talked about the fact that, the labor market is remaining intact, even though consumer spending is slowing, and this lack of inventory. Mortgage rates at 7%, who that's sitting on a 30-year mortgage is ready to sell their house? I'm certainly not. So, we're seeing some strength in the housing market. We're seeing some strength in other lagging data. But if you look again at the leading economic data, things like weekly manufacturing hours work, the ISM index of new orders, consumer expectations, those are all still flashing. By the way, not to mention the yield curve, which 2s10s are at 103 basis points the last time I checked before the show. So all of those things are still telling us the same signal. But here's the thing. They can work with a really long lag. In fact, right now, we're at a period between when the leading economic indicators index went negative 11 months ago, and we still haven't seen the recession. Similar pattern that we've seen in other cycles, most notably, hate to use the example, but 06, 07, it was 16 months between the period when the LEI went negative and the recession. So these are periods where you want to stay invested, by the way. You just want to be mindful of overreaching for risk.
Emily, you mentioned the yield curve, negative 102 right now, negative 103, there and thereabouts. Aaron, can I get a comment on that? How meaningful is that? A 2-year at 485 and a 10-year at 382. What does that even mean?
Yeah, no, it's a real sort of conundrum in some sense, because the equity market's sending one signal and the bond market, not only the inverted yield curve, and it's been inverted for a long while, which tends to give even more credence to its signal that a recession is around the corner, if not the back half of the year, the first half of next year. Which wouldn't surprise us here at Clear Harbor. We are of the view that, that there are some weights on the market, and we need to be very, sensitive to those weights going forward. But certainly we do see value in certain components of the fixed income market, particularly if you think the Fed is 1 or 2 and done. You look at long-term inflation expectations, the 10-year break-evens are at 2.25, and you can own T-bills at over 5%. And even the 10-year rate well above that rate. Historically, those are not bad times to dip in the market.
Aaron Cannon, Emily Rowland, to the two of you, thank you. Just breaking down the price action and a ton of earnings going into the opening bell, about 15 minutes away. We are at session lows on the S&P 500, down about 0.4%. On the Nasdaq 100, down by almost 1 full percentage point, negative by 0.93%. Let's get our teeth into some of those earnings reports out there. We can do that with Abby. Morning, Abby.
Good morning, John. And yeah, it feels interesting today to have the futures down so solidly, not something that we've seen very often in this melt-up. And it has everything to do with these earnings you're talking about, especially Netflix and Tesla. Starting off with the shares of Netflix, heading to the worst day of the year potentially on a revenue miss and a weaker guide, despite the new subscription blowout. The stock, of course, up more than 60% year to date into this quarter. Investors wanted perfection. They didn't get it. Something similar for Tesla, but this stock actually up 136% on the year into the quarter. A margin miss not tolerated. Plus, CEO Elon Musk, well, he's saying if rates keep rising, they're going to have to keep lowering prices. An example of the pain of rates rising in real life. And then finally, KeyCorp. We still have some of these regional banks reporting their second quarter total deposits of about $143 billion basically met, but they had to pay up more, that interest expense rising, so the shares down sharply.
Abby, thank you. Stocks are down. The bond market's down too. Yields are higher by 8 basis points on a 2-year. Jobless claims in America, actually decent news. Downside surprise. I always say the right kind of downside surprise on jobless claims. 228,000. The estimate was 240. The previous read was 237. Coming up next on this program, President Biden ramping up his messaging on the U.S. economy.
I don't think the problem in America today is too many people working or working people are making too much money. Instead, we focus on getting Americans into the workforce by fixing a broken supply chains and lowering costs.
The latest in Washington, up next.
Bidenomics is about increasing competition, not stifling competition. When companies have to compete, it means lower prices, fair wages, and more innovation. The Department of Agriculture and partners in the states are going to make large corporations making sure they cannot artificially raise food prices through price fixing and price gouging. We're cracking down on hidden junk fees in rental housing.
President Biden announcing new actions to aid U.S. consumers. The latest efforts coming as polls show the president underwater when it comes to key parts of the economy. That includes the labour market, even with jobless claims near historic lows and unemployment around 3.5%. Bloomberg's Anne-Marie joins us now from Washington, D.C., alongside Mike McKee here in New York. And Mike McKee, the latest data, pretty decent.
Well, you got to go back to the Bill Clinton campaign in 1992. James Carville, his campaign manager, said it best. It's the economy, stupid. And every year it turns out to be the major issue. And if that's the case, well, I'm reminded of Ronald Reagan running for re-election in 1984 after 2 recessions left the economy sort of reeling. Look at jobless claims. Those are Reagan's last three for this period of time in his 1983 position. And then these are the Joe Biden numbers for 2023. Biden in much better shape. But their polling results, as you mentioned, are just about the same for this period in their incumbencies. You can see Biden basically running right alongside where Reagan was, and that was not good for Ronald Reagan, but we all remember what happened after that. You get to 1984, and Reagan swept the election, winning every state except Minnesota. The difference was that the economy by that time had put the bad news behind it, and it was morning again in America. And so Joe Biden has to hope that jobless claims are a harbinger of that as we see inflation go down and unemployment stay low.
AMH, we've asked this question a lot, why that data isn't translating into better polling.
Well, it's really how people feel. We spoke to Amy Walter yesterday for the Cook Political Report, and she said even if the data is starting to show inflation is quelling, this has been top of mind of American voters. The issue is maybe Americans just aren't feeling it yet. Things are still costing more. Jonathan, only 3 in 10 Americans, they say the country is doing better than the rest of the world when it comes to the economy coming out of the pandemic. And when you look at a recent AP poll, when you look at Biden's handling of the economy, that was about some 34%. That was lower than his overall approval rating, but is why you see this administration really try to own Bidenomics. This term that when I first saw it was from an opinion piece in the Wall Street Journal that said the president really had little knowledge of the private sector economy. It was quite critical of him. They are trying to now own this narrative and talk about the legislative agendas, packages that they were able to get through when it comes to fixing roads, fixing bridges, expanding broadband, diffusing the debt ceiling. The problem is, Jonathan, will it land for voters in November of 2024?
Well, AMH strategy, tactics, let's build on that a little bit more. We look at that data. Mike McKee's gone through it. Jobless claims historic lows, unemployment incredibly low, 3.5%. And then the administration focuses on junk fees I've never heard of. Have you ever heard of some of these junk fees?
Well, I think the issue is why they're probably focusing on things like junk fees is because this probably polls well with Americans. Americans don't like the idea that they're being have these extra fees when they're focusing on buying, using in their credit card or whatever it may be. The administration seems to be, or Biden seems to be quite obsessed with that. So I imagine that's showing up in the polling data as a good point instead of going out with these hard numbers. Remember, Biden likes to talk in very plain terms to the electorate. We saw that this week. He was talking about consumers when he convened his competition council, and then he's going to be doing the same today. He's going to Philly Shipyard in Philadelphia, and he's going to talk about Bidenomics, building from the middle class out. But I spoke to the Treasury Secretary this week, and she was pretty clear. She says that the U.S., she thinks, could avoid a recession.
AMH, thank you. On the latest, Anne-Marie down in Washington alongside Mike McKee on the latest economic data and on the latest polling too. Coming up, the morning calls and later, the latest earnings. Netflix, Tesla, kicking off earnings season for big tech. That conversation's still ahead with Mizuho's Vijay Rakesh and Stifel's Barry Bannister. 5 minutes away from the opening bell. Nasdaq underperformance here, down 0.8%. The S&P negative by about a third. That's the price action. Here are some morning calls. Deutsche Bank downgrading Avis to hold, expecting a volatile Q2 earnings season after the stock's notable gains this year. JP Morgan raising its Netflix price target to $505, recommending investors buy the dip with a longer-term outlook remaining solid. And finally, Piper Sandler raising its Tesla price target to $300, saying nothing from the conference call questioned the broker's bullish thesis. We're negative there, about 4%. Coming up, more on Tesla's latest results with Mizuho's Vijay Rakesh, plus Stifel's Barry Bannister calling time out on the equity market rally. Your opening bell, just around the corner. Three-day winning streak on the S&P 500, about 20 seconds away from the opening bell. Equity futures just a little bit softer, negative by 0.3%. Tons of earnings out there, disappointments for the likes of Tesla, Netflix. We'll get into that in a moment. The Nasdaq is negative about 0.8%. There's the opening bell. Switch on the board and get to the bond market. Earlier this morning, about an hour ago, jobless claims, the right kind of downside surprise, yields up 6 basis points. A week yesterday for a Fed decision, looking for another hike in July and looking for guidance on what they might do beyond that in September. Your 10-year, 380, 90. Your 2-year, up 7 basis points to 484. In the FX market, just a touch of dollar strength. We break 112 on the euro, a week away from an ECB decision. 111.86 with negative 0.1% there. And crude, just a break of 76, almost up 0.8%, up 60 cents on the session on WTI. We're about 30 seconds into this. We're negative 0.2% on the S&P. A whole lot more negative on the Nasdaq. The one stock to watch at the open is Netflix. Under pressure after projecting a weaker than expected outlook. The company writing to shareholders, we have more work to do to reaccelerate our growth. Abby has more. Hey, Abby.
Hey, John. And what makes that interesting is that case could be true ahead of the quarter, because going into the quarter, you had the company looking at revenue growth for this year of mid-single digits. Right now, 7.1% revenue growth on the year. The stock up 60%. That's why you have this stock heading to its worst day of the year. It was priced for perfection. Investors simply did not get it. Now, what was interesting, because of the password crackdown, subscribers really surged, but it didn't equal big revenue. There was a little bit of a revenue miss, and the revenue guide is disappointing. So that's what investors are really weighing in on this stock. Now, Morgan Stanley does expect Netflix to deliver on its year-end target to reaccelerate that revenue growth by double digits for the fourth quarter. So that's pretty aggressive. They do have their work cut out for them. They will have to translate some of those ad subscribers to fully paid subscribers. One point of agreement on the street is exactly that, in fact, that the password crackdown has not equaled that yet. One positive, though, John, is the profitability for this company. They did have put up 22% margins. They also posted $5 billion in free cash flow. So it's not all negative, but investors right now, with this stock down 6.4%, really focused on the fact that they want the revenue to come from the password crackdown.
Abby, thank you. More on this story a little bit later. Mandeep Singh joining us on the program. Let's turn to Tesla. The automaker warning of more hits to its shrinking profitability. Elon Musk downplaying margin concerns and saying this: it makes sense to sacrifice margins in favor of making more vehicles because we think in the not too distant future they will have a dramatic valuation increase. David Welch joins us now for more. David, the stock is down by 4%. Can you explain what Elon Musk meant by that?
Well, I think if you look at the vehicle market, it's relatively strong. There's still not a lot of inventory out there, so people are still looking for cars. Maybe he's just generally looking at the strength of the consumer and that people will be buying vehicles and that they're not going to have to do as much discounting. But it was honestly pretty vague. I don't think investors are really buying it, obviously, because the shares are down. And I think in the case here, there's sort of a sin of omission. The one thing that Tesla didn't say, which they've often said, is that they want to maintain industry best margins. Because the amount of margin slippage in the quarter wasn't bad. These were overall pretty good numbers. But investors are looking ahead, and Tesla's not committing to that the way they typically have. And I think investors are just saying, okay, if they're not committed to industry best margins, then profits are going to be under pressure going forward. And Elon's not really explaining how he's going to boost the value of these vehicles. Part of it is some of the software and things they want to put in these cars, but it's not really explained. Near-term investors are kind of thinking they'll put their money someplace else and wait to see how all of this shakes out.
Explains the weakness this morning. We're down 4%. You have to think about that relative to the gain so far year to date, though. Before that move, we were up by something like 135%. David, thank you. David Welch there on the latest. From autos to airlines, American Airlines reporting quarterly profits in line with expectations. The more modest outlook coming after a strong report from United. Isabel Lee has more. Hey, Isabel.
Hi, John. It's vacation season, so maybe this is timely. But yes, American Airlines shares are falling, down about 4%, after quarterly profits were just in line with Wall Street's expectations. Adjusted earnings will be 85 to 95 cents in the next quarter. That's smack in line with the that's actually above the 90-cent estimate. So it was a modest outlook that offered investors a reality check. And this came after United Airlines and Delta really offered strong reports. United came in with strong third quarter and full year earnings estimates. The company said it will earn more this quarter thanks to a travel rebound. Year to date, though, American, Delta, and airlines are seeing gains north of 40%. And overall, we're seeing a global recovery as travel rebounds. So people are expecting it to surpass 2019 levels, so we'll see how that plays out.
Massive gains year to date on those names. Isabel, thank you. We talk about big tech all the time, the dominance of these magnificent 7 stocks. Need to talk more about airlines. And for me, the story of the year, right here, the home builders in America. D.R. Horton topping earnings estimates thanks to a tight housing market. The company saying, quote, despite higher mortgage rates and inflationary pressures, our net sales orders increased as the supply of new and existing homes at affordable prices remains limited. Katie, I wouldn't say despite, I'd say because of mortgage rates. This is what they're doing.
This is what they're doing, and it was a beat and raise quarter for several factors when it comes to D.R. Horton. Of course, like you said, mortgage rates. We know that D.R. Horton has been using mortgage rate buy downs to make those houses more affordable. They said that doing that really cuts rates by about 1%. And also that shortage of U.S. existing homes has been a big boon for D.R. Horton. They said that fueled a 37% jump in purchase contracts to nearly 23,000. That is well above analyst estimates. And to tie it all together, D.R. Horton actually reported fewer deal cancellations in this quarter at 18%. That number was 24% a year earlier. You take a look at the shares, though, and it's pretty interesting. Right now, we're about flat. We actually dipped negative as the bell rang. We had been up as much as 8% in the pre-market. We are getting the call right now, getting some comments from executives. They did say that significant increases to mortgage rates would hurt margins. So maybe you're seeing some of that caution in the shares right now. I will note, though, that D.R. Horton is about $2 away from an all-time high. But even at these nearly record high levels, D.R. Horton has been underperforming the industry overall. The S&P index of home builders up nearly 56% this year. D.R. Horton currently about 48% higher in 2023.
What a run. Katie, thank you. No doubt Katie covering that a little bit later on this afternoon. Let's turn back to Tesla. Stocks lower by almost 4%. The automaker beating second quarter expectations, but the company warning about more hits to profit. Mizuho's Vijay Rakesh saying this: with a weaker consumer and higher rates, Tesla has been leveraging price to drive volume at the expense of profitability. While margins could remain a key concern for investors near term, we could see second half tailwinds from commodity and logistics cost declines. Vijay joins us right now. Vijay, just build on that if you can. What do you see going in their favor in the second half?
Yeah, thanks for having me on. I think as you look at the second half, obviously Q3, they did say there'll be a small slowdown in the production side, but we think that could be made up by the inventory that they have on hand. But going into the second half, obviously, if some of the cost declines on the logistics and the raw material side start to hold, that could continue to help them on the gross margin line. One key highlight I would say on the June quarter was despite almost 200 or 900 bips of pricing cost cuts or price cuts on their Model 3, Y, and S, etc., the gross margins for Tesla were down only 100 bips. That shows massive cost efficiencies that they're leveraging across their supply chain. So
that's been an area of huge improvement for them across the last several years, you could argue. Vijay, you mentioned inventory. Global inventory, a lot of people pointing out it's up to 16 days. Now, Vijay, I'm not deep in the weeds in the auto market like you are. Can you tell me how significant that is?
I think that you have to differentiate a little bit between, let's say, Tesla's own inventory at like 50,000 units, which is, is pretty small, versus the global auto inventory, which is definitely going up. I think that's more a function of some of the consumer taste moving from combustion engine to electric vehicles, but also, as you mentioned previously, high rates. It definitely becomes a drag on the consumer to having to pay these high loan rates while buying the vehicle. So that's definitely going to be a drag, we think, on the second half on the broader automotive market. But for EVs in specific, you have a lot of subsidies that are flowing through the system. At the same time, you have OEMs like Tesla trying a little bit more flexible with pricing to the consumer. So that should help.
Tons of subsidies, yet, Vijay, at the same time, Ford cutting prices, inventory climbing at the likes of Tesla. There might be some people watching this, listening to it, Vijay, saying that maybe actually we've tested some of the limits of demand out there at the moment for some of these vehicles. What would you say back to that?
Yeah, I mean, I think there is still room to grow. I think if you look at the pricing on these Model 3 and Ys, they definitely come down, but it's putting a lot of pressure on the ecosystem. That's why you're seeing Ford, et cetera, which you do not cover, but seeing, their inventory spiking up, they're cutting pricing. But, let's not forget, if you look at Tesla, they're running 10% operating margins on a $100 billion annualized business. And that compares to many of the startup and legacy OEMs that are running electric vehicles at 30% negative operating margins. So there's a massive moat between what Tesla is running at scale versus you can characterize some of the other EV OEMs still at subscale, still ramping up. But that's a huge I would say, a positive for Tesla. So.
Vijay, thank you, buddy, for catching up with us on a busy morning for you. I know you've got a lot of calls to make, so thank you, sir. Vijay Rakesh there on Tesla. Tesla negative this morning by around about 4%. On the S&P 500, we're down about 0.1%. Stifel's Barry Bannister shifting his focus from big tech towards cyclicals, writing this. We continue to see the S&P 500 level at around 4,400 for the remainder of 2023, with cyclical value outperforming cyclical growth. This occurs as a result of rising real yields, pressuring PE valuations, and because 23 is conforming to our view of a slowdown without a recession. Barry Bannister joins us now for more. Barry, I'll say up front, you were constructive and right for 2023. Let's take it to the next place you want to go from here. Do you think the market cap weighted S&P 500 from here then is going to be challenged? And if so, can you give us the why?
Yeah, I think we're a few percent overvalued. I do think we end the year around 4,400 on the S&P 500. Since mid-year, we've been saying that one of the trades you could do was long equal-weighted, short cap-weighted S&P for a broadening of the market. The other, as you mentioned, is the cyclical value, and that's really banks, diversified financial services, industrials, basic materials, and some of the transports.
Barry, do you think that's a short-term tactical play through the summer? Heard a lot of people say there's a sweet spot here for disinflationary trends, or do you see it being somewhat more sustainable than that?
Well, you know, policy works with a lag, and recessions tend to come as surprises. I do think the employment markets will weaken towards year-end. You've got corporate pricing power with a weak PPI, weakening inflation. You've got corporate pricing power falling below wage growth, and wage growth being fairly high is keeping the core PCE ex housing, which is called super core inflation, above what the Fed's comfortable with. So if the Fed is not willing to accept that the normal run rate for inflation going forward with positive goods prices and strong services demand is going to be closer to 3% at the core level, and they're still talking 2%, then they're going to stay tighter for longer, and eventually that'll weigh on the market into 2024.
Do you think, Barry, that's a September time story? That until then we're in this nice spot and equities can do nicely?
Well, we've both been doing this long enough to know that September, October are treacherous months for the market. So if there's going to be any pullback towards this 4,400, it would probably be at the end of the summer and into the early fall. And as we conclude the year, though, we do think employment markets will weaken. And once they weaken just a little bit, it won't take much. It would be a pre-recessionary signal. We would know that at some point in 24, a recession, however mild, was coming. And one thing I would throw out there, Jonathan, is I'm pretty bullish on oil prices from the supply constriction side. I actually think we're going to have a mini oil shock in 2024. And when that happens, on top of unemployment, you could see a lot of tumult on the interpretations from Washington of what's going on.
Barry, just out of interest, are you positioned for that now? How would you suggest someone positions for that out on the horizon out in 2024?
No, I mean, everything is a rental now. Everything is a trade. If you think back to 2022, utilities, energy, they were great. Then they were terrible in the first half. Tech was terrible last year. This year, it was great in the first half. The cyclicals, the banks, they were terrible in the first half. Now they're going to be good. You know, you really can't get too far ahead of yourself and over your skis when you're investing in this kind of a market. We are not in a buy and hold 10-year-long double-digit bull market anymore. We have to be very tactical in how we trade this thing.
Well, let's focus on a tactical trade then, Barry. Just a final question from me. What are you telling clients? Do you do this through a single name, through a sector, through an equal weight index on the S&P? What are you suggesting?
You know, like I said, it's heresy for a broker to say this, but there are ETFs to trade everything. And so if you were long RSP, the equal weighted S&P, and short SPY, that's the long equal weight, short cap weighted. The other is if you buy the KBW Bank Index. KBW is a subsidiary of Stifel, KBE on the ETF. You can participate this in multiple ways. There are sector spiders and industry spiders at BlackRock that are perfectly good for trading just the names of industries that we just listed.
Barry, appreciate your time today. And again, great call so far year to date. It's interesting to see you make a change in the last month or so. Barry Bannister there of Stifel on the equity market, just making a tactical call for this market to broaden out away from the dominance of big cap tech, but ultimately putting a time limit on it and then raising a flag potentially on a risk around energy for next year. Fascinating stuff. 15 minutes in, we are just a little softer by by 0.1% on the S&P. On the Nasdaq, that's where your underperformance is this morning. And this is where it is at a single name level too. Coming up, Netflix delivering a disappointing outlook.
Listen, Netflix is winning the streaming wars. There'll be some consolidation. Pricing will be raised by the others, and marketing costs will come down, and they'll eventually turn profitable. But Netflix clearly has the lead and will be the long-term winner.
That conversation up next.
Only a small percentage of our members are on the ads tier, even with the moves we just mentioned. Nice growth in the ads tier, but still off a small base. And we're really early in terms of paid sharing impacts, including extra member, for the reasons that Greg mentioned. That's going to build up over multiple quarters.
Netflix CFO Spencer Newman weighing in on the earnings call. The stock heading for its biggest drop of the year after delivering a disappointing outlook. The company writing this: while we've made steady progress this year, we have more work to do to re-accelerate our growth. Geetha Raghunathan of Bloomberg Intelligence joins us right now. Geetha, this is the $195 billion question this morning. How do you beat subs by as much as they did and then come in light on revenue? What happened?
Yeah, that's really puzzling. So, I think what happened was obviously their paid sharing crackdown, or their password crackdown, kind of went into effect. It looks like that was obviously a success because, you did have that big, it did spark that increase in subscribers. I think what has happened, though, over the past few months is Netflix has actually cut prices in many international markets in order to kind of reinvigorate that subscriber growth. I think that's what we saw kind of flowing into the ARPU a little bit, as well as I think what happened is Netflix was probably hoping that with that password crackdown, they would kind of really get it to be a catalyst for people signing on the cheaper ad plans. And remember, again, the ad plan, you're paying only about $7, $8 for subscription, but you're making up the rest through advertising, which kind of makes it equivalent to a standard plan with $15.50 in the US. I think what happened instead were maybe people started to sign up for the ad-free plan, which came in at about $10. And I think yesterday's move by Netflix to actually eliminate that plan, both in the US and UK, shows that they do want to kind of drive ARPU higher. So I think there's, different moving pieces here, lots to parse out. But I think maybe the revenue impact that they were hoping for obviously is going to flow in a little bit later than they had initially anticipated.
Geetha, do you think that's something you can achieve in one quarter? Does it take several quarters? How long do you think it would take for that to be successful?
So I think investors were definitely expecting. So Netflix itself has outlined this revenue target or reacceleration of revenue growth in the double-digit territory. Obviously, that's not happening in the third quarter since they guided to about 7.5% growth. However, I do think that, with all of the different initiatives in place, and as those effects of, password crackdown and the advertising-based plans kind of start to flow through, it will happen in the fourth quarter. So we actually think that, Netflix gets to that 10% growth in 4Q, and then we're definitely going to see a much bigger ramp up, I think, in revenue in 2024.
Just one final one, Geetha. I know you're super pressed this morning, but just on the strikes in Hollywood, did they flag that as a concern on the call at all?
They started the call with the strikes, and they said that they're really looking to kind of achieve an amicable solution as quickly as possible. They didn't want the strike. They wanted to get resolved as quickly as possible. But having said that, they are really not in as bad of a situation, even with the strikes going on. In fact, it's actually going to boost their free cash flow. They boosted their guidance for free cash flow by about 40%. So yes, if it drags on, it will be a problem. But right now, no immediate financial impact.
I hear that from a lot of analysts, particularly relative to the competition. Geetha Raghunathan there of Bloomberg Intelligence. About 22 minutes in to the session, we're down 8% on that name. We're down about 0.1% on the S&P. Let's get you some sector price action. Here's Abby.
Based on that small loss, John, this is not intuitive, but most S&P 500 sectors are higher. But what we are looking at is that consumer discretionary dragged down by Netflix, down 1.4%. We also have community communication services and tech down. So that's really the heavyweights dragging on the index, whereas energy, healthcare, utilities, financials, staples, and industrials higher. As for the real estate sector, earlier you were talking with Katie about D.H. Horton. We have the real estate sector on the day, or over the last few days, down 1.8%. It's interesting because DHI all over the map, and SL Green, an office property owner here in New York, the biggest one, John, well, they reported disappointing outlook in terms of, or I should say, lower rents for the quarter that just was. That stock down, John.
Abby, thanks for the latest. That's some of the soft spots right now in the equity market. Your trading diary. Up next, the runway into the weekend. Snapping a three-day winning streak on the S&P 500. About 26 minutes into the session, we are negative by 0.07% on the Nasdaq. Your underperformance, we're down by about 0.5. That's the price action. Here's the trading diary. Existing home sales at the top of the hour. You'll hear from the president again at 1 p.m. Eastern on the economy. The Nasdaq's rebalancing happening over the next week, into next week. Tech earnings ramping up Tuesday with Alphabet, Microsoft, and Snap. And finally, Fed rate decision. That's next Wednesday with a Chairman Powell news conference. From New York, that does it for me. Thank you for choosing Bloomberg TV. Good luck for the rest of the trading day. This was the countdown to the open. This is Bloomberg.